So the Indian rupee has touched the 90 mark already, and this might just go further. Let's discuss the impact on you. Hello, my name is Abhinav Trivedi and you are watching Mint Explains. Now, overall prices of products which come from sectors which are import dependent will go up. Which are these sectors? Auto sector, gems and jewellery, gold, white goods and electronics, crude oil, minerals, rare earth, plastic are likely to get expensive as we speak. Not only that, manufacturers of smartphones, laptops, televisions and major appliances have already indicated plans to hike prices by around 3 to 7% starting December to January. The price hike aims to compensate for these manufacturers for increased cost of memory chips, copper and additional components resulting from rupee depreciation. Please understand, because the rupee has been depreciating, so the amount of money which manufacturers will have to spend to import similar amount of import materials will go up. So companies like Havells have indicated a 3% increase in LED TV prices already. Superplastronics plans 7 to 10% higher prices, and Godrej Appliances will raise product prices by 5 to 7% for air conditioners and other refrigerators. GST reduction benefits will be completely negated because of this depreciation. You see, consumer goods manufacturers have privately also informed the government about this price rise. The rapidly expanding beauty market in India with international brands faces challenges due to rising prices now because most of them are imported, in addition to 18% GST on cosmetic buys. The biggest impact though will be felt in the auto sector, where GST reduction will be completely negated as the auto sector depends heavily on imports of items. The sentiment though has been questioned by business leaders like Harsh Goenka, who mentioned in a tweet recently that the higher rupee will make imports costlier and high inflation, but will also result in stronger exports. A gradual slide to 90 is not a worry for me, he said, and can actually help the economy. Well, time will tell how true is that. But as of now, India's central bank will tolerate a weaker rupee as the country's external sector confronts multiple headwinds, including a wider trade gap and stalling of dollar inflows into the world's fifth largest economy because FPIs have been withdrawing money consistently. It doesn't make sense to spend reserves when fundamentally everything is against the currency. India is one of the worst hit markets in terms of outflows, with foreign investors selling stocks amounting to $17 billion so far this year, and 20 days are still pending. You'll be surprised that the outflows in the first 2 days of December were more than the entire November month. Such is the condition. At the same time, foreign direct investment, trade and offshore fundraising flows have also slowed down. India's GDP grew by 8.2% in the July-September quarter, at least that's what the official numbers tell us. But those numbers are now being questioned by traders, investors and economists, as a lot of cracks in the economy have been exposed. The rupee languished at a record low, underscoring a divergence between the strong domestic economy and weak external demand. So far this year, ladies and gentlemen, the rupee depreciation will likely continue because of global uncertainties, rate cut, dilemmas, and a lot of other factors are playing in handy. We at Live Mint shall keep you posted with all the developments. Stay tuned for more such updates. I, along with my team, shall see you in the next episode. Shabba khair.